into the alternate market news, and this is where it get a bit lengthy because there's loads and loads of things to share with you. So stand by your cameras, your picture, your lighting material, because this is going to go long. Okay, let's go. Now, first of all, we do expect we saw something interesting. The put and call open interest is going up. That means that more and more people are buying put. So, of course, why more and more people buying put? Because the market is so right, people are getting a bit worried. But the question is this, okay? The question is this, all right, cool, we have more people buying put, so we should expect to sell, right? But do you know that at the same time itself, the bullish impulse is there? So apparently speculators boost bullish bet on global stocks by the most in the 2 years. That means that now the bullishness is as high than the 2 years ago. That's back all the way. So this is very interesting. This is very, very interesting. Why is people so bullish, all right, into the market while they are buying more put? All right, so the thing is this, I can only give you my fair assessment. It's likely, first of all, the put may be a hedge. So to hedge against this buyout so that in case anything go wrong, they can be hedged. Number two is, all right, maybe they are buying the stock market because they know that the stock market may be coming down. So the put itself acts as a form of a protection. Now, the third one is a little bit more ridiculous, but it's all possible. It's just because you don't know what's going on. You just basically follow the crowd. So that's the reason why people say buy into the global stock you buy. People say buy do the put, you also do. So it becomes like you don't know what you're doing, and at the end of the day, you may be squared off without earning a single cent. So all these are all the potential of things happening. So this is something that I also want to tell you that I'm kind of confused right now, because now you can see that the decade high mortgage rate is really at a high level. And of course, if you look carefully, it's right, the housing rate is going back to 2018 again. So which means that whatever happened in 2018 and then now has never changed, and it's back to the same level once again. Now, of course, the central bank around the whole world itself is all increasing the interest rate. All you can see are all increasing, and there'll be more increment by the mid of 22 to October itself. So when more people are involved in cutting rate, right? Doing rate hike, sorry, my bad. Doing a rate hike, right? That means that the market, the funds will reduce, because when the rate hikes go across globally itself, right, this will increase the what they call the tightening, and that will reduce money supply. So this will again affect the market. So you can understand why now, but at the same time, there are more people spending. Why? Because if they don't spend right now, they may not have the money to spend later. And of course, if their earnings are not there and the stock market itself is not performing in a way, and there's no other alternative, then they will have to buy into credit. It means they take a credit from the banks, and the bank will charge them quite expensively. And of course, they'll be paying through their nose to do that itself. So apparently, this is what is happening, right, in this overseas and all the US banks. Now, of course, this is where we use very traditional way, the stochastic. Now, this is spent 2020 to now. So every time when the stochastic actually turns down in this manner itself, right, you do expect to see the S&P 500 or the S&P to drop quite significantly. The only thing it didn't drop was here. It did drop, but it wasn't significant. Now the question is, now the thing has crossed itself, right? Will there be any significant profit taking in the market? Now this is something that you may want to ask, but just so you know that what conventional traders are losing and using right now. But the thing is this, according to Larry Williams, right, you can see very clearly when the effective fund rates are actually going down, then the recession will start. You see, every time when the yields start to go down, then that is where the recession really starts. So you can see that. Okay, this one, he basically doesn't care. He didn't want to get involved. So for this one here is where we are right now. I think that you shouldn't be getting involved. So now what happened is this. That means that the last two times when it happened, when the yields coming down. So that means that now the yields haven't go up yet. So for yield to go up and come down will be next year, right? So that means that recession next year, not now. That's what this picture is trying to explain here. Now you can see that this is very interesting from Larry Williams. It shows that, right, whenever inflation is actually downwards, stock market itself is able to go upwards. Interesting, yeah? All right, so if the inflation itself is going upwards, as you can see, the inflation has been priced down lower in a way. All right, the only thing is this, now the inflation is still at the bottom. Would that be a possibility that the market, the thing goes up this way? Then of course, if that happens itself, right, we all know if the thing goes up, okay, right, the stock market will come down. Can you see that? When the thing goes up, the stock market actually come down. So if let's say if this is going to happen, then there will be further selling. But the moment now, all these people now, in terms of this expectation here itself, right, it's not there. So maybe we may have a different, I don't know. All right, but you can see very clearly this is a 10-year yield and 2-year yield combined. Now, every time itself when it combine, right, and it bottom out, can you see the stock market will actually fall? So now we actually have a double bottom here, and the stock market is at a high. And of course, we all know that there was some what do you call unhappiness between the two of them over here. So if that's the case, are we talking about the same thing now? The market may have to fall further so that, right, they can bottom out to go up later. Now I kind of stick to this position B because I think that it will happen. That means that the market will go down first because of the whatever reason. All right, and then after that, right, people get to come in, and that was where the market will turn you around. So what do you think, guys? If you think that you agree with this statement itself, hit the word agree. Okay, I'm gonna see whether you agree with what I just shared. Now, this is the US Investor Intelligence Survey, and you can see every time when this thing comes down to the 0% mark, now usually the stock market also follow. But now the thing is this, at this point now we are almost so near, and the stock market came off a bit, but did not really follow. So we can't say it followed. So the only nearest was here itself, and of course it did, and the what do you call the casualty involved will get much lesser. Yeah. So that means that from here, could the stock market be going up itself? It is all possible. Yeah. Everything is all possible depending on the market situation. Okay, now this is the inflation cycle forecast. Now it shows that, right, based on Larry Williams seasonal pattern, there could be a peak on it very soon. Now we all know that, right, yesterday in Goldman Sachs said it might hit a peak. Some people say that it may hit a peak. So if that's the case, then probably from now till this 18th of April, it will be good to take note of your movement in the market. If the inflation continues to go up itself, it's kind of expected. But once it hit to the high point, which is something like maybe 4% or something like that, that's where you get very careful because we actually do funny stuff. And of course, if the inflation really hit a peak, then if it starts to come down, it will be very powerful for the stock market too at the same time. So that's why there could be another trip down to see how it goes from here. Now, of course, this is what I showed to you already, right? Whenever the inflation is actually coming off itself, you notice that when the inflation is actually going downwards, the stock prices go up, but also periodically go down, and this is what happened. So for this particular scene itself, right, you can see that something like this, it was down, although it's very far away, but still, if the market can be convinced and all the candidates can agree, we can see that the stock market actually goes up. So inflation itself is not necessary, it's bad for the market. And here you can see that it really raised the market after the initial sell-off. So take note of that, yeah? All right, so this is the junk bonds against the yields. And you can see that the orange is S&P. It does shows that the market itself is going to be near a potential peak soon. So which means that if the thing goes too high, as you can see here, it may actually blast and in more stuff here. All right, so some traders to be very, very careful. Things doesn't suit you at the moment. That's why drinking some soup will be much, much better. All right, this one is the junk versus the bonds, and you can see that they hit a strong resistance, and very soon that we have an answer. Now, Federal Reserve will hike rate until something breaks. I think that's something quite clear as well. And of course, the last one will be this using an advance and decline indicator by Larry Williams once again. He has proven that, right, if you actually follow through, it's not too bad. It's not 100%, but it's decent. Yeah, not every time it's perfect. So now you're saying that, right, by the mid of May, the market may see a top. Okay, if you look at this recent rally. But after that itself, right, it will be coming down really crazily by the 14th of February. So that imagine that this is 14th of May, 15th of May, sorry. It may happen on there itself, okay? And then after that, the market may recover all the way. So according to Larry Williams, the best one to be playing safe itself, there might be a mixed rally on the 5th of June, right? 5th of June. Yeah, I think 5th of June should be somewhere around here, but yeah, I think it's talking about this rally here. Not too sure. It shouldn't be here, I think so. So this is from Larry Williams. You can go to this YouTube and find for his latest video, yeah? And of course, this is the one that he's saying. He said that because of that, based on the cyclical pattern, right, for April to June, we may see the gold going down. But the thing is this, gold go down, Now, this is not the magnitude of the selling or buying. It's just telling you the direction. Now, he says that likely there will be some profit taking until June. Okay, lah. Seasonal patterns seem to be like that, lah, but I do not really agree to it 100%. Yeah, I do not really agree. So this one is the individual to see. Some will agree, some will not agree. So this one, I leave it to you to decide. Yeah. Okay, so with that, we come to the end of the